back to the Forex Lounge. Fundamental Extras. Today is Tuesday, June 22nd, 2010. Welcome back, one and all. Great you could join us. Today, Bloomberg.com reports Canada's annual inflation rate slowed in May because of a moderation in gasoline costs and lower prices for clothing. The Consumer Price Index, CPI, rose 1.4% in May after a 1.8% gain in April, Statistics Canada said today. The core rate that excludes 8 volatile items slowed to 1.8% from 1.9%. Economists forecast the inflation rate would be 1.3% and the core rate 1.7%, according to the median of 20 estimates in a Bloomberg News survey. Looking at the charts, we see the blue line, which is the year-over-year Canadian CPI, Consumer Price Index, again slowing to 1.4% from the previous month of 1.8%. The violet line represents a 12-month moving average, so we're still well above the 12-month moving average, although declining at the moment. And if we pass below the 1.4% reading of March of this year, we would then look at levels we have not seen since the beginning of the year. Canadian CPI slowing to a degree. The next chart shows us the blue line, the Bank of Canada historical interest rates. The Bank of Canada just raised interest rates from 0.25 to 0.5%. During the same period of time, we can see the Canadian CPI year over year has slowed again to the 1.4% level. Historically, as CPI increases, the Bank of Canada raises interest rates. As the CPI drops, the Bank of Canada cuts rates. Lately, we've seen the Bank of Canada start to raise rates as the CPI has exploded to the upside after reaching very critical lows going back to September of 2009. However, if CPI continues to drop, we may expect the Bank of Canada will not raise rates in the near future again. The next chart shows us Canadian CPI. That's the violet line, again at 1.4%. The blue line represents a TSX. That's a Toronto Stock Exchange, the stock market. Typically, as CPI increases, this tends to bode well for equities. However, when CPI drops, we tend to see equities move down. If the CPI drops below the 1.4% reading of this month, we may expect stocks to continue to slide. Compare now Canadian CPI, that's the violet line, to the dollar-CAD currency pair. Now the Canadian dollar is a second currency within this pair, so there's an inverse correlation, meaning as CPI goes up, the dollar-CAD tends to go down. As CPI drops, the dollar-CAD tends to rise. CPI now dropping, we would tend to believe that the dollar-CAD would rise. Now, of course, it's not a perfectly fair comparison, as there are two currencies within a dollar-CAD currency pair. However, generally speaking, over time, stronger economies are reflected by a rising CPI. A rising CPI tends to lead the Bank of Canada to raise rates, and that expectation of higher rates tends to lead to strength in the Canadian dollar. With that said, if you have any questions, do not hesitate. Email us anytime, info@forexlounge.com. We thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon. Back inside the Forex Lounge.